late to the game. So I really give him very little chance.
Even with his $50 billion.
I don't think that's a positive. In the Democratic Party today, where vilification of wealth is a common theme, it seems like a delicious irony that one of the people that's running is the eighth richest guy in the world with $50-odd billion. It just seems so out of step with the tone of the party. I have a hard time believing it. I think the strongest Democratic candidate would be Hillary Clinton.
Now, you said that on the webcast yesterday. You were serious.
I am serious. She's the strongest candidate the Democrats have. That doesn't mean that she's a great candidate. It just shows the fractured nature of the party, and the consequences of that fracturing are a lot of. It's really two or three parties. It's very much the Democratic Party here for 2020 is very much like the Republican Party ex-Trump was in 2016. It was a whole bunch of kind of non-impressive candidates that were somehow trying to fit themselves into a mold without a real overarching ideology. I think that's sort of the problem there. So the base case really is that Donald Trump is going to win re-election.
Who are you supporting?
I don't support political candidates.
If the status quo remains and Trump does win, what does that mean for markets?
Well, it's probably more positive than him losing, I would say, because the rhetoric, the themes of the opponents certainly are probably anti-market. I mean, one of the questions, you mentioned my webcast yesterday, one of the questions that came up, someone said, is the market overreacting to Elizabeth Warren? And I said, what are you talking about? Elizabeth Warren is obviously not being taken seriously by the market. If the market was taking Elizabeth Warren seriously, it would not be near an all-time high. It would be down substantially because she clearly would want to have anti-corporate policies. One of the reasons that the stock market did well under Trump, for sure, is when you cut taxes, you turbocharge the bottom line. Earnings go up on a net basis. Elizabeth Warren vows devoutly that she's going to reverse that, and so do many of the Democrats. So the market is actually telling you, I think, that the base case is Trump is going to win, and so that would continue to be a supportive aspect to the market.
Is that playing into where you think money's going to be made in the couple years ahead, expecting that Trump's going to win and then positioning therefore?
I think
because if you're worried about
buy the rumors, sell the news type of situation, I think the reality of the market positives for Trump are in the market. I think the market has absorbed those and believes in it. I actually think that much more than politics, I think what's really important for making money in a couple of years ahead is I think you have to start fundamentally believing that the dollar is going to get weaker. And I think you're supposed to orient your thinking around that, which means that foreign currency investments should be superior to U.S. dollar investments. I think that the dollar topped almost 3 years ago on the Dixie basis. It was at 103, and it's down at a 97 handle today. And I think that we go back and take really big picture views. My favorite chart of this year, we may have talked about this before, but it's worth repeating if we didn't, or even if we did. If you go back to the 1980s, so very long-term view, you divide the world into 4 regions: Japan, Europe, United States, and emerging markets. And something very interesting has happened. Over that 35-year or so period, there's been every one of those 4 regions has had a moment where they were world beaters. They were viewed to be invincible. First, it was Japan in the late 80s. It was invincible. The value of the Imperial Palace land, which is fairly small in Tokyo, was actually viewed to be the same as all of California. Japan was that strong. They were manufacturing everybody out of business. Remember? The Nikkei was by far the best stock market in the late 80s. Then the recession came in the early 90s, and the Nikkei was the worst market, and it hasn't been back since. 30 years later, it hasn't come close to that 1989 level. Then came the euro in the late 1990s, and there was tremendous enthusiasm. It would be a reserve currency potentially. There'd be a lot of cooperation. It was the ascendancy of Europe, and the European stock market was by far the best in the late 90s. Then came the recession in the early 00s, and it got kneecapped. Hasn't been back there since. 20 years later. Then, in the middle of the 00s, it was a weak dollar. Emerging markets were strong with the weak dollar, and China was very much on the rise. And emerging markets were by far the best stock market in the world. Now, what happened? Global financial crisis, Emerging markets got wiped out. They haven't been back since. Well, who's the world beater now? For the last 10 years, by far, it's the United States. The S&P 500 has blown emerging markets, Japan, and Europe totally out of the water over the past 10 years. That's partially because earnings have been better in the United States. It's partially because economic growth has been better in the United States. It's also because of financial engineering, which ties into that corporate bond thing, where you're able to get a lot of free money for corporations to do buybacks. It's also the tax cut. Well, my view is that this pattern will repeat, and that in the next recession, the United States will be the worst stock market in the world. The dollar will be weak, and I don't believe we'll get back to whatever highs put in again in my career, similar to what happened to Japan, then Europe, then emerging markets. So I think that that's what you're supposed to be thinking about, and the linchpin to that thesis is that the dollar will be weaker thanks to the exploding deficits and the Fed going back towards zero.